All right, if you're watching this right now, pause the scroll for 10 seconds and hit. So this gets to the right people, because something serious just happened. Silver just fell 21.5% in 24 hours, from roughly $120 an ounce to about 97. That's not a typo. That's around $1.4 trillion in value erased in a single day. And here's the urgent part. The real trigger isn't what most headlines are blaming. Both major futures desks and physical dealers confirmed the same thing within hours. This wasn't collapsing demand, it was forced selling. Stay with me, because I'm going to show you why this kind of move usually marks a transition, not the end of the story, and how you can recognize it next time before the crowd does. Before I explain what caused this, let me teach you something most people never really learn about markets. Price doesn't always move because beliefs changed. Sometimes price moves because positioning breaks. Think of the market like a packed elevator. It can feel fine on the way up, smooth, quiet, everyone confident. But if too many people are leaning on borrowed support and one cable snaps, the drop isn't about the building, it's about leverage. Silver didn't suddenly become 20% less useful in a day. What changed was the structure holding the price up. And once you see that distinction, you start reacting differently. You stop asking, what news did I miss? You start asking, who was forced to act? That's the shift that separates people who panic from people who position. If this is making sense so far, drop a comment below and let me know where you're watching from, because this matters globally, and I want to know who's paying attention. Now here's what's actually happening. Let me break down the sequence the way traders see it in real time. Silver had gone parabolic, not just up, but accelerating, vertical, crowded. That attracts leverage. Futures, options, synthetic exposure, all piled on because momentum rewards speed. When something's moving that fast, everyone wants a piece. But here's what they don't tell you. That speed comes with a cost. The cost is fragility. Then volatility spikes. When volatility spikes, margin requirements jump. That's the first domino. Exchanges don't ask if you're comfortable. They just raise the collateral you need to hold your position. Overnight, your $50,000 position might need $75,000 in backing, and if you don't have it, you're out. When margin jumps, weaker hands get margin calls. That's the second domino. These aren't suggestions, they're automatic. You either post more cash or your broker liquidates your position for you. And when margin calls hit en masse, selling becomes automatic, not emotional, mechanical. Contracts get liquidated at market, pushing price lower, which triggers more margin calls, which forces more selling. That feedback loop doesn't care about fundamentals. It doesn't care about inflation or industrial demand or anything else. It only cares about clearing risk. So you've got this cascade. Price drops 5%, more margin calls, another 3%, more forced selling, another 4%, and suddenly you're down 20%. And nobody's selling because they changed their mind about silver's future. They're selling because the math told them they had to. That's the critical insight here. This wasn't a vote of no confidence. It was a liquidation event. But here's the part that should make you nervous in a good way. You can often tell it's happening because volume explodes while physical demand doesn't disappear. And that's exactly what we're seeing right now. Dealers in Asia reported premiums staying elevated even as paper prices collapsed. Let me say that again. Physical silver, the actual metal you can hold, was still commanding premium prices in Asia while the paper price on exchanges was getting demolished. That divergence matters. It's like watching a house sell at auction for half price while the neighborhood hasn't changed, and people are still lining up to buy homes on that same street. The sale price reflects urgency, not value. Here's what that tells us. The physical market, where actual industrial users and long-term holders operate, didn't panic. They didn't suddenly decide silver was worthless. The paper market, where leverage lives and trades happen in milliseconds, had a structural break. Two different markets, two different signals. And when you see that split, you're watching forced mechanics, not fundamental repricing. Now, here's where it gets really interesting. Once forced sellers are done, they're done. There's no one left to panic sell. The margin calls have been met. The positions have been closed. And that's when price stops falling and starts discovering where real buyers actually live. Because the buyers who were waiting on the sidelines, the ones with cash and patience, they're still there. They didn't go anywhere. This is the exact same playbook we've seen before. Let me take you back. In 2008, Silver collapsed during the liquidity crunch, not because it was worthless, but because everything levered got sold. Remember that? The financial system was seizing up. Cash was king. Nobody cared about future value. They cared about meeting margin calls today. Silver dropped from around $20 to under $9 in a matter of months. People called it the death of precious metals. What followed? A multi-year rally that took silver to nearly $50 by 2011. Same pattern. Then in 2011 itself, you had a violent smash that followed a parabolic run and extreme margin hikes. Sound familiar? CME Group raised margin requirements 5 times in 8 days. 5 times. Positions that were comfortable on Monday needed double the capital by Friday. Silver dropped from $49 to $32 in a week. That wasn't the end of silver's relevance. It was the reset. It was the market purging excess so it could figure out what the real clearing price was. Fast forward to March 2020. Remember the pandemic panic? Silver was obliterated during the dash for cash. Everything got sold. Stocks, bonds, gold, silver. Didn't matter. If you could sell it, you did, because cash was the only safe asset when the world was shutting down. Silver dropped from $18 to $12 in 2 weeks. Then what happened? It doubled within months. By August, it was at $29. Every time we see this pattern, fast collapse driven by forced selling, it marks an inflection point, not a quiet fundamental top where demand slowly fades, an inflection point where structure breaks, price resets, and the next chapter begins. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this keep falling? Yes, absolutely. Price doesn't care about your timeline. Price doesn't care that you bought at 110 or 115. It's going to go where supply and demand and positioning take it. Could there be manipulation? Let me be honest with you. Markets are messy. Incentives matter. There are big players with big positions, and they don't always act in your interest. But here's the thing. Obsessing over villains doesn't help your decisions. What helps is understanding structure. Whether someone intentionally pushed the market or it broke on its own, the mechanics are what matter. Focus on what you can control: volatility, liquidity, position size, time horizon. If you anchor on those, you don't need a conspiracy to explain what just happened. You just need to understand how markets work under stress. There are probably 3 types of people watching this right now. The first is the trader who was long and got hit. Maybe you were holding futures. Maybe you were in levered ETFs. Maybe you woke up to a margin call or a stop loss that took you out at the worst possible price. If that's you, I get it. This hurts. You were right about the direction, maybe for weeks, and then this happened. But here's what I need you to understand. The decision now isn't about what you hoped would happen. It's about what your risk plan says now. If you were over-leveraged, the market already decided for you. That's done. The question is, do you have conviction in the thesis and capital to re-enter at better levels? Or is this a signal to step back? Only you can answer that. But don't let emotion drive the next move. The second type is the investor who believes in silver long-term and is staring at this chart thinking, is this my chance? You're not trading volatility. You're building a position over months or years. Your edge is patience. You don't need to catch the falling knife. Let the market prove stabilization. You don't need the bottom tick. You need confirmation that the forced selling is done and price is finding support. That might be next week, it might be next month. But when it does, you'll still have plenty of upside if your thesis is right. Wait for your setup. The third type is the skeptic who thinks this proves the whole trade was wrong. You've been hearing about inflation hedges and monetary debasement and all of it, and now you're looking at a 20% drop in a day and thinking, see, this is why I stayed out. Your caution is healthy. But remember, this move didn't come with a collapse in physical demand. It came with a collapse in levered positioning. Time horizon matters. Different tools for different players. If your thesis is long-term and structural, one day of forced selling doesn't invalidate it. The universal rule for all of you is the same. Don't let forced action by others force emotional action from you. When the market is in mechanical mode, you need to be in strategic mode. So here's what I want you to answer in the comments. Which of those 3 categories do you fall into? And what's your next move? I'm genuinely curious because this community is sharp and I learn from your perspectives. So here's where I stand. I'm not panicking and I'm not blindly buying. I'm watching. Let me tell you what I'm personally watching. First, I'm watching the $95 to $100 zone to see if price stabilizes and volatility compresses. If silver can hold above that range for a few sessions without retesting the lows, that tells me the forced sellers are done and we're finding equilibrium. Second, I'm watching whether futures open interest keeps falling. Open interest is the total number of outstanding contracts. When it drops during a sell-off, that's contracts getting closed, which means the leverage unwind is happening. When open interest stabilizes or starts rising again, that signals fresh positioning, not liquidation. Third, I'm monitoring physical premiums, especially in Asia, because when paper and physical diverge like this, repricing usually follows. If premiums stay elevated, that's your signal that real demand is still there. Based on my analysis, this move was mechanical, not emotional. It was structural, not fundamental. The fundamental picture around silver hasn't changed in the last 24 hours. Global debt is still at record levels. Central banks are still navigating inflation and growth trade-offs. Industrial demand for silver in solar panels, electronics, and green technology is still projected to grow. None of that disappeared yesterday. What disappeared was weak positioning. If history rhymes, and I think it does more often than people realize, this wasn't the end of silver's story. It was a chapter break. It was the market clearing out excess, resetting expectations, and setting up for the next leg. That doesn't mean we rally tomorrow. It means the conditions for a meaningful move are being created right now. The question is whether you're positioned to take advantage when it happens, or whether you're going to be one of the people watching from the sidelines saying, "I knew it would bounce, but I was too scared to act." I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Talk to people smarter than me. But if you made it this far, you're the kind of person who wants to understand how things actually work instead of just reacting to headlines. That mentality will serve you well. Markets reward patience and pattern recognition, not panic. If you found this valuable, share it with someone who needs to see it. Subscribe if you want more breakdowns like this when markets move. And stay sharp out there. Think critically, verify the data, and make your own decisions.